All right, so in order to tame inflation, the Fed is set to increase rates 3 times this year. In addition to that, we've seen the fixed rate 30-year mortgage increase by 0.5% over the last 30 days. What does that mean for us in 2022? Buying, selling, or investing in real estate? Well, let's go ahead and talk about that. Make sure to like and subscribe and leave a comment. Let's go. All right, so here from Reuters, we're taking a look. The Fed is set to tighten monetary policy at a much faster pace than thought a month ago to tame persistently high inflation, now viewed by economists polled by Reuters as the biggest threat to the U.S. economy over the coming year. Now, this is something that we've heard about for the last couple years. To deal with the pandemic, we've seen increased credit, increased money into the money supply, and that has helped ease, in some people's mind, the pain caused by the pandemic. But what has that also done? Well, it's increased the cost of assets. So the real estate market has increased, and it's also increased the cost of some goods and services. We've seen inflation go up. Now that has been good for some people, especially if you've owned real estate, but it has been tough for other people as well. So in order to combat inflation, the Feds are looking to tighten up their monetary policy and to increase the Fed rate. Before we get into this video, let's talk about the Fed rate and how that might be influencing mortgage rates. So the term the federal funds rate refers to the target interest rate set by the Federal Open Market Committee. The target is the rate in which the commercial banks borrow and lend their excess reserves to each other overnight. So what does this mean? Each bank, so let's say Bank 1 and Bank 2, they have to keep a certain amount of reserve in reserve in order to pay for the withdrawals that depositors request. Now this sometimes is transferred. The Bank A will lend to Bank B because maybe Bank A, they need to have 10,000 in reserves and they have 12,000, and Bank B has 8,000 in reserves and they need 10,000. I'm just using real simple numbers, and Bank A lends overnight to Bank B in order to make sure that they have the right amount of reserves that the Feds set. Now, the Feds can control or influence the Fed fund rate, which is that percent interest that they can charge, that overnight amount of lending the money in order to make sure that they have the reserve. So that's the definition. It is an important aspect of affecting credit and some consumer prices, but it's not directly connected to the mortgage rate, but it is an influencer and it does affect the stock market. So in order to combat this inflation, a lot of the politicians and the Wall Street guys are actually encouraging a tightening of the monetary policy, and they are encouraged by what Jerome Powell is doing. So we can see here, Biden backs Fed Chair Jerome Powell's likely monetary policy tightening as inflation rages. And now, how does that affect inflation? Well, it's one, it affects that fund rate, but another way, tightening things up means that they might not buy as many mortgage-backed securities as they would before. So your lender, if you go to a lender that is a non-portfolio lender, right? So you can go to a lender that makes a loan and then sells it on the secondary market in order to free up some more cash to go and lend more, make more loans. But in a portfolio lender, they'll actually hold on to the loan for you and you'll pay them directly. And so there's a little bit of a difference there, just so that you know. But typically, when you get a loan and the loan broker gets a loan for you, they'll sell it to the secondary market, and there'll be investors that buy these mortgage-backed securities, and then they will make a certain amount from that, and the lender will make their income from actually writing the loans and interfacing with you as a borrower. So if the Feds reduce the amount of mortgage-backed securities they buy, this will affect the overall monetary policy and the economy. So let's talk about mortgage rates. With this monetary policy tightening up, we're also seeing the mortgage rates increase, so money is becoming a little bit more expensive to get. And as we can see here, bankrate.com, mortgage rate forecasted for 2022, rates will climb modestly as the Fed fights inflation. So let's take a look historically at what the mortgage rates have been. So back in 1980, we've seen quite a big difference from that point. We 30-year fixed rate mortgage average at 18%, and it's gone down pretty steadily. In 1993, 6.96, 2009, 4.85, and then all the way down at a low of around 2.69, 2.7. Now, it doesn't mean everybody got that, but we were seeing, as a real estate agent myself, we were seeing some really low rates for people, and they were really excited. So we saw a lot of refinances for people to get that low rate locked in, and that was a great thing for them. It has made the assets for real estate, the real estate prices go up, because as we can see, when money is cheaper to borrow, that means that you've got more money that you can offer for a house. So let's say, for example, you're a borrower and you can afford $1,500 a month in your mortgage, right? And let's say you have 20% down on a $500,000, or it'd be more like a $400,000 house or a condo. You're just starting out, right? Then you're going to be looking at that and saying, hey, well, my budget is $1,500, and so if I put down 20%, I can afford, $350,000 or whatever it is on your mortgage. But if the rate goes down, the interest rate goes down, that means you can offer a bit more for that house, or maybe step up into a nicer house in a nicer neighborhood and still have that same monthly payment. So that's really what is on the mind of borrowers, what their monthly payment is. So it's an important thing to keep in mind. We have seen historically the rates go from 18% all the way down to about that 3%. But now we're seeing these rates climb up, and we can take a look at the chart in the last 30 days. So August 2021, we saw the rates 2.77. In just last month, in December, I'm making this video on the 21st of January, but last month in December, we saw the rates increase. We saw December 23rd, 3.05%, and now in January of 2022, so January 20th of 2022, we saw the rates go from 3.05 to 3.56. Now, what does that mean? It doesn't seem like a whole lot. How does that actually translate in real life? Well, let's take a look at this. For every 1% rate increase, your buying power will decrease by 11%. So if you're taking a look at a 0.5% increase, you might say that your buying power would decrease by about 5.5%. Now, so that's pretty significant. Each time interest rate goes up by 1%, your buying power decreases by 11%. Well, how is this going to impact the market? Well, we're going to talk about that in a second. But let's take a look here first at California real estate prices. So we can see here Q2 1980, their transaction price index for California was 112.93. And then we got a high right here of 800.74. So we've seen an almost 7 times increase for that price index, the house price index for California. And we've seen Q3 in 2021 have reach the height, and we've seen that kind of correlate with the interest rates as well. So as the interest rate goes down, the house pricing tends to go up. Why? Well, it's pretty simple math. If you're paying a 25% interest rate, you can only afford X amount on the actual purchase. And if the interest rate goes down to 1% or 2% or whatever it is, something really low, 3% in this example, then you're able to offer more or make up the difference in the purchase price, right? So because people are concerned about their monthly payment. That's an important thing to factor in. So wages have increased over the years, and that has had some factor, a big factor into the cost of the real estate, but we've seen that the interest rate has a direct factor or direct correlation. Lower the interest rate, the higher the real estate prices. All right, so what does that mean for us in 2022? Well, what I see is with monetary policy, monetary tightening, and the mortgage rate going up, I think that we're gonna see, there's gonna have to be some give. So what I think is, what we're gonna see is we're gonna see a little bit of softening in the real estate market. Now, there's still gonna be that increased demand. People are gonna continue to want to live in California, but I think that we're going to see a little bit of a softening for the real estate prices in the upcoming months. And as we go into the end of the year of 2022, and as the mortgage rates go up, unless we see a diminish of the inventory, we're gonna see those prices go down a little bit. I've seen a lot more building, a lot more new construction in California, at least the area that I live in, San Luis Obispo. And so that may be, with that push of increased inventory, higher rates, we may see that decrease in the price, right? So if a buyer purchasing power is decreased when the interest rates go up, well, either they go, like I said, they have to negotiate down the price, or they have to tier down to maybe not quite as nice of a neighborhood or a house that requires a little bit more fixing up. So what I think is going to potentially happen is in the higher luxury homes, we're going to see the strength of the pricing stay, because generally speaking, people aren't as tight. Their loan to income is not going to be quite as tight as you would see maybe on a mid-level or step-up house. So generally those folks put down a larger down payment. The interest rate is not going to impact them quite as much. So I think in the luxury end, we're going to see the prices maintain kind of their steady, what they've been historically. But I think in the step-up homes, in the maybe $600,000 to $900,000 range here in San Luis Obispo County. Now it's different in every county here in California, but I think that the prices are going to dip just a scotch or soften just a little bit. But I also think that at the more of the entry level type of home, we might see a little bit more of a push up. Why? Because the people that maybe they can't get that tiered up house because the interest rates have gone up, maybe they're looking a little bit, they're stepping down to take a look at some maybe a starter or fixer up type house. And as the people that are looking for those starter fixer up houses or the investors, maybe there's going to be a little bit more competition with that. So that's a possibility. I don't know, but that's just something I've been thinking about. What are my suggestions? Well, as interest rates are lower, I would definitely suggest locking in your refi. Most people who've looked at refinancing their house have done so already. Pretty smart move for a lot of those folks. If you're a buyer out there, make sure that you have an up-to-date pre-qual letter, because what you might have been able to afford last month is not going to be what you can afford this month. And then also I'm seeing that people are going to be probably saving up some more money for a down payment. So this isn't all bad. This could be actually a good way to make a more healthy, a more normalized real estate market, because it has definitely been an abnormal market and we've seen those prices go up quite a bit. Now that, like I've said, has been partially due to the low mortgage interest rates. So those are some of my thoughts. I think with the increase of the mortgage rates and the Fed's tightening things up, we're going to see the tightening up of credit or loans, and we're going to see those asset prices go down a little bit. So if you're a seller, I definitely start, if you're thinking about selling, sell now. If it's already in your thought process, and if you're a buyer, gear up. Maybe there's going to be some more deals for you in the upcoming months as inventory reaches the market in springtime, but make sure that you've got an up-to-date pre-approval. So what do you think? Leave a comment. I'd really be interested to engage in your thoughts for what's coming up in 2022 with these real estate mortgage rates going up and the Fed's tightening up the monetary policy. Does that mean that we're going to see a decrease in the real estate prices? Let me know your thoughts below. Hope to see you again on the next one. Make sure to like and subscribe. Bye now.